There is a financial transaction available to the majority of American homeowners right now that costs $250, permanently reduces a monthly mortgage payment by $540, requires no credit check, no appraisal, no income documentation, and leaves the existing interest rate completely untouched. The return on investment on that $250 fee, measured against the total payment reduction it produces over the remaining loan term, exceeds 64,000%. This transaction is documented in the Fannie Mae Servicing Guide and the Freddie Mac Seller/Servicer Guide, the regulatory documents that govern approximately 70% of outstanding American mortgages. Almost no servicer mentions it. This video is the complete analytical framework. The data, mathematical frameworks, and institutional mechanisms presented here are sourced from federal regulatory documentation, Consumer Financial Protection Bureau research, Federal Reserve data, and published academic work in behavioral economics and financial decision-making. This content is produced as financial education. It does not constitute personalized financial advice for your specific loan or circumstance. Mortgage eligibility, servicer requirements, and optimal financial strategy vary significantly by individual situation. All decisions involving the movement of capital should be reviewed with qualified professionals who have full knowledge of your specific circumstances. Now let us start with the architectural reality that makes everything else in this analysis possible to understand. When your mortgage was originated, a formula was executed. That formula is called the present value of annuity calculation, and it took three inputs: your principal balance, your interest rate, and your loan term. It produced one output, your required monthly payment. That formula ran once. On the day your loan closed. It has not been run since. And unless you invoke a specific mechanism, it will not run again for the entire remaining life of your loan. Every extra dollar you have ever sent to your servicer as a principal payment entered a completely separate system, a balance tracker that updates your outstanding balance and recalculates your payoff timeline. These are two distinct machines. The payment calculation machine and the balance tracking machine do not communicate. Extra principal payments flow into the second machine and stop there. They accelerate your payoff. They reduce your total interest cost. But they have no mechanical connection to the first machine, the one that generated your required monthly payment. This is why a homeowner who sends $80,000 as a principal curtailment and a homeowner who sends zero will receive identical monthly billing statements the following month. The bank processes both through the balance tracker. The payment remains what the original formula produced. And the formula does not re-execute unless you specifically trigger the one process that restarts it. Understanding this two-machine architecture is not merely a financial observation. It is the foundational reason why the mechanism we are about to examine exists, and why most homeowners have never used it. Before we examine that mechanism, there is a piece of behavioral science worth deploying here, because it explains something most homeowners have experienced without understanding. When you send a large payment to your mortgage company and watch the balance drop, you feel something real. A genuine sense of progress. A reduction in financial anxiety. This is not self-deception. Nobel Prize-winning research at Princeton and the University of Chicago, documented by Dr. Daniel Kahneman in the formal framework called dual process theory, identifies two cognitive systems operating simultaneously in every financial decision you make. The first system is fast, emotional, and heuristic-driven. It sees the balance drop and generates a genuine satisfaction signal. That signal is biologically real. The second system is slow, analytical, and deliberate. It notes that your monthly payment statement shows the same number it showed last month. System 1 responded correctly to the information it received. System 2 is pointing out that the financial outcome you needed did not occur. This cognitive pattern has been formally named in the behavioral economics literature as debt aversion bias, the documented preference for visible balance reduction that persists even when the cash flow impact is zero. This is not a character flaw. It is documented human cognitive architecture. And the mechanism we are about to examine is specifically the System 2 correction, the process that routes the balance reduction through a recalculation that produces the cash flow outcome your System 1 already celebrated prematurely. That mechanism is called a mortgage recast, or formally, re-amortization. It triggers a recalculation of the original present value of annuity formula using two updated variables, the new, reduced principal balance after a lump sum payment, and the remaining term of the original loan. The interest rate does not change. The loan number does not change. The servicer does not change. The loan terms do not change. The only thing that changes is that the payment formula reruns with a smaller principal input and produces a permanently lower required payment. Let us run the complete numbers so this mechanism is not abstract in any way. Consider a loan originated at $400,000, at a fixed rate of 6.5%, on a 30-year term. The original monthly payment, calculated by the formula at origination, is $2,528.27. After 60 monthly payments, 5 years of consistent payment, the outstanding balance has been reduced to approximately $374,000, with 25 years remaining. Now introduce an $80,000 lump sum principal payment. The balance drops from $374,000 to $294,000. Without a recast, the payment calculation machine sits idle. The balance tracker updates. The required monthly payment on next month's statement reads, $2,528.27. Unchanged. Now invoke the recast. The payment calculation formula reruns using $294,000 as the new principal, 6.5% as the rate, and 25 years as the remaining term. The formula produces a new required monthly payment of $1,988. The permanent monthly reduction is $540.27. The cost to trigger this recalculation is a one-time administrative fee of approximately $250. Now let us convert that into a return on investment figure using standard financial analysis. $540 per month, multiplied by 12 months, multiplied by 25 remaining years, produces a total payment reduction of $162,000 over the life of the loan. Divide $162,000 by the $250 fee. The return on investment on that fee exceeds 64,000%. No standard financial product in any regulated market produces a documented 64,000% return on a $250 investment. That number is not hyperbole. It is arithmetic applied to the documented mechanism. Now let us examine the institutional dimension of this, because understanding why your servicer did not proactively mention this option is as important as understanding what the option does. Mortgage servicers, the companies that collect your monthly payments, earn revenue through several documented channels. The primary channel is a servicing fee, typically calculated at 25 basis points annually on the outstanding loan balance. On a $374,000 balance, that fee generates $935 per year for the servicer. Post-recast, on a $294,000 balance, that same fee generates $735 per year, a permanent annual reduction of $200 in servicer revenue. The recast fee the servicer collects from you is $250, one time. The ongoing annual revenue reduction from your lower balance is $200, permanently. This is not a conspiracy. This is rational institutional economics. The servicer's incentive structure does not reward proactive recast disclosure. The recast is available. It is documented in the applicable servicing guidelines. And it is accessible to any eligible borrower who requests it by name. The word is the unlock. The servicer will not use it first. The eligibility architecture is the next critical variable, because this mechanism does not apply universally. Per the Fannie Mae Servicing Guide and the Freddie Mac Seller/Servicer Guide, conventional loans governed by these agency guidelines generally permit re-amortization upon borrower request and satisfaction of minimum requirements. Approximately 70% of outstanding American mortgages are conventional loans, per Urban Institute Housing Finance data. FHA loans, governed by HUD guidelines, generally do not permit reamortization. The monthly payment structure is governed by the FHA insurance framework, which does not accommodate payment recalculation. VA loans, governed by Veterans Affairs guidelines, similarly do not provide for recast. Jumbo loans vary by investor and servicer and must be confirmed individually. USDA loans generally do not permit recast. If your loan is conventional, the permission exists in writing in the governing servicing documents. If your loan is FHA or VA, this specific mechanism is not available to you, though separate pathways exist, and this analysis will identify them. For those with conventional loans, the comparison between a recast and a refinance deserves a complete cost accounting, because this comparison is where the recast's full advantage becomes undeniable. A refinance requires origination fees ranging from 0.5% to 1% of the loan amount, an appraisal typically costing $400 to $800, title search and insurance in the range of $1,000 to $2,500, recording fees, attorney fees where applicable, prepaid interest, and escrow setup. The total realistic range for refinancing costs on a loan in the $200,000 to $400,000 range is $6,000 to $12,000. The recast costs $250. No appraisal. No title work. No credit check. No income verification. No new loan. No change to loan identity. But the cost comparison, as significant as it is not the most important dimension. The most important dimension is the rate calculation. For any borrower who originated a mortgage between 2019 and 2022, the current rate environment has transformed their existing mortgage into a calculable financial asset. If your mortgage carries a 3% rate and current market rates sit at 6.5%, you possess a 350 basis point rate advantage on your remaining balance. Running that differential forward over 25 years on a $294,000 balance, the net present value of your rate protection, measured as avoided interest cost relative to refinancing at today's rates, exceeds $150,000. Your rate is not a sentimental attachment. It is a documented, calculable financial instrument with a specific six-figure value. The recast preserves that instrument. A refinance extinguishes it. That comparison is not close. Now let us examine the four scenarios that exist from the moment of a lump sum principal payment, because most financial content presents one or two. All four deserve to be modeled with complete metrics, because which path you choose determines everything about what that $80,000 actually produces. Scenario 1, no lump sum, no recast. You continue paying $2,528 on your $374,000 balance for the remaining 25 years. Total interest paid over that period is calculable and represents the maximum interest cost of all four paths. Scenario 2, lump sum payment without recast. The $80,000 payment reduces the balance to $294,000. The monthly payment remains $2,528, contractually unchanged. However, because the balance is lower, that same payment now accelerates the amortization significantly. The loan pays off years ahead of the original schedule. Total interest paid is reduced substantially relative to Scenario 1. Monthly cash flow freed, 0. This path produces the best total interest outcome of any path, but with no cash flow flexibility. Scenario 3, lump sum payment with recast, paying only the new minimum. The balance is $294,000. The recast recalculates the payment to $1,988. You pay only the required amount each month. The loan amortizes over the full remaining 25 years on the new, lower schedule. Total interest paid over 25 years on the lower balance at the full remaining term is slightly higher than Scenario 2's accelerated payoff, because the extended time allows more interest to accrue even on the reduced balance. Monthly cash flow freed, $540 every month. Scenario 4, lump sum payment with recast, continuing to pay the original amount voluntarily. The balance is $294,000. The recast has set the contractual floor at $1,988. You voluntarily continue paying $2,528 each month, the same amount you were paying before. The $540 monthly excess above the new floor applies entirely to principal. The loan accelerates beyond even the Scenario 2 payoff timeline. Total interest paid is the lowest of any path involving the recast. Monthly cash flow freed in normal months, 0. Monthly cash flow freed in any month with an income disruption or financial emergency, $540, automatically, with no phone call, no application, no approval required. Scenario 4 dominates all other options across all financial metrics when the homeowner has the cash flow to sustain the original payment. It produces the lowest total interest, the fastest payoff, and a permanently documented payment floor that activates automatically in any month where the full original payment cannot be made. The additional cost of Scenario 4 over Scenario 2 is $250. The benefit over Scenario 2 is permanent payment optionality for the full remaining loan term. That is the pro move. Before the execution protocol, the qualification framework must be stated directly, because the recast in the wrong sequence is the wrong decision. Priority 1 is non-negotiable. Liquid emergency reserves must exist before any mortgage optimization is considered. The Consumer Financial Protection Bureau's research on mortgage delinquency documents that the primary trigger for payment failure is income disruption, job loss, medical emergency, family financial disruption. These events are temporary in the majority of cases, but they require liquidity to navigate without default. If executing the lump sum payment would deplete or significantly reduce a 3 to 6 month liquid emergency reserve, the recast does not execute. No mortgage payment optimization is worth stripping the cushion that prevents the mortgage default. Priority 2, high-rate consumer debt elimination precedes any mortgage optimization mathematically. Average credit card annual percentage rates in 2024 reached 21.59%, the highest ever recorded. A mortgage rate of 3 to 6.5% is a substantially lower cost of capital. Every dollar deployed toward mortgage principal while carrying credit card balances is earning a negative arbitrage against the card rate. The highest rate debt clears first. This is mathematics, not preference. Priority 3, loan type confirmation. Conventional loan holders proceed. FHA and VA holders stop here and pursue the alternative pathways appropriate to those loan structures. Priority 4, confirm the servicer's minimum lump sum requirement. Most servicers require a minimum principal curtailment in the range of $5,000 to $10,000. Confirm the specific threshold before moving capital. Only when all 4 prerequisites are satisfied does the recast execute. The execution protocol has 6 specific steps. Step 1, identify your loan type from your original closing documents or your monthly mortgage statement. Look for the classification, conventional, FHA, or VA. If unclear, your servicer can confirm in a 2-minute call. Step 2, call your servicer, not your original lender, but the company you currently send payments to. Open with this exact language: I would like to request a mortgage recast, also called a reamortization. If the first representative does not recognize the term, ask to be transferred to a loan counselor or a loan modification specialist. The term reamortization is the technical language embedded in the servicing guidelines and is more likely to route your call to the correct department. Step 3, confirm the specific requirements. Ask, what is your minimum principal curtailment for a recast? What is the administrative fee? What is the processing timeline? Are there any restrictions on how many payments must have been made before a recast is eligible? Step 4, confirm the delivery mechanism for the lump sum payment. Wire transfer, certified check, or online payment portal. Confirm the specific routing and verify that the payment will be coded as a principal curtailment, not as a regular monthly payment or advance payment. Step 5, request written confirmation of the new required payment amount and the recast effective date before and immediately after the transaction processes. Step 6, Verify the new required payment on your first post-recast monthly statement. Confirm it matches the written confirmation. Confirm the remaining term is correct. If you are continuing to pay the original higher amount voluntarily, verify that the excess is being applied to principal on the statement. Retain the written recast confirmation permanently. Here is the complete architecture in one unified view. Your mortgage payment was calculated by a formula that ran once and locked. Extra principal payments update the balance but do not trigger a recalculation of that formula. The recast is the specific administrative request that restarts the formula using the updated balance, producing a permanently lower required payment while preserving the rate, the loan identity, and the servicer relationship. The institutional disclosure structure creates a documented information asymmetry. The servicer's revenue model does not reward proactive recast disclosure, so eligible homeowners with cash, with equity, and with a qualifying conventional loan are paying a contractual monthly obligation that could be permanently reduced for $250. The Pro Move captures the payment reduction, preserves the rate, accelerates the payoff, and creates a financial optionality floor for every month of the remaining loan term. Same money. All 4 outcomes. The next step is one phone call. The question is, I would like to request a mortgage recast, also called a reamortization. If the institutional mechanics described here represent one layer of the financial architecture that affects your household, the next analysis maps the remaining systemic vulnerabilities that most homeowners carry without knowing their names. Click to examine how many your current financial structure is exposed to right now.